Hi, my name's Rich Allen, your business coach today. And we are kicking off a new course that's called Business Mastery. And Business Mastery is all about working on the 4 fundamental areas that you have to master in your business before you go do anything else that's more elaborate or sophisticated. We got to get some of the fundamentals down. And today is the first course in this 4-course curriculum on Business Mastery. And today we're going to be talking about financial mastery. You see, this is a critical piece of your fundamental success in business. You've got to understand how the numbers work in your business in order for you to be successful. If you don't understand the math, if you don't understand the numbers, if you don't know how to keep score, then how are you going to know if you're winning or losing? And that's what we're about to do today. We're going to dive into some fundamentals that I want you to make sure that you have nailed down in your business around the financials so that you can be successful in your business. Now I want to start here. I want to start with your beliefs about money. There are some people that hold real interesting and sometimes challenging beliefs about money. And your beliefs about money matter. How you feel about money will influence how you deal with financial mastery. Let me give you an example. If you're of the opinion that money is hard to come by, then you're going to treat money a little differently. Where on the other hand, if you are of the opinion that money is simply there to be made, there to take advantage of it, do the things you need to do, and you can have a piece of it, then you're going to behave a little differently. So before you dive into the money side and into the financial side of your business, you need to make sure that you get your head in the right place around your beliefs on money. See, money is just simply a concept. It's a concept that's backed by your activities, right? So you can change how you feel about money, and it will absolutely change how well you do your activities in your business. It'll make you a better person when you're talking to a prospect. It'll make you understand how you can better deliver your services to your customer, all by having a solid confidence in the promise that you're giving them, the value exchange that you're giving them for the products or service you deliver, that they're worth the money that you are asking, and that you're earning every bit of it. If you're of the opinion that you have to discount or devalue your product because it's going to take that for somebody to get it, that's going to influence how you act about the profitability in your business. So you have to spend some time. Get it down on paper. If you have some hesitations around whether you are valuable enough, whether your product and services warrant the kinds of prices that you're asking, you need to resolve that first. It's a fundamental thing you've got to get down in your business, the beliefs. Now, I want to talk about one of the principal ideas in your business, and that's your margins. Understanding the margins that you make on every product or service that you sell in your business is pretty critical. And it's going to build to something that I'm going to talk about in a minute here. I call the break-even analysis. But let me first make sure that you understand how margins are calculated in any business. Yours may be more complicated than this, but I'm going to give you just a simple look for it, and I want to make sure that you're doing this in your business. There are several things you have to understand to be able to calculate your margins. One is you have to know what your revenues are. Your sales are equivalent to your revenues. So the products or services you sell, those are dollars coming in, those are revenue dollars. You subtract from that what I'll call your variable costs. Some call that your cost of goods sold, or COGS, cost of goods sold. Those are the costs that directly relate to the product or service that you're selling. So the revenue from your sales, less your variable costs, or your cost of goods sold, leaves you with gross profit, or some people call it gross margin. but gross margin or gross profit. That's the net, the gross incremental margin that you have from selling one item or delivering one service. And then when you put multiples together, you can get your gross profit from multiple sales of products or services. Then you subtract from your gross profit your fixed cost. Some people call those overhead costs. Those are costs that occur whether or not you sell a product or a service. So whether or not you make a sale, there are some costs in your business that just happen. Rent, for example, utilities, perhaps your phone bill, mileage. There may be some things that happen in your business. Whether you sell a product or not, those are called fixed costs or overhead costs. So your gross profit less your fixed costs gives you your net profit. Now for you, it's important that you understand this on a singular sale basis. So what does this formula look like for you if you sell one average product or one average service that you provide? And then you also can aggregate this so that you can do this calculation on either a week's worth of activities, a month's worth of activities, so that you'll understand how to make a plan for your business. But you need to understand your margins. Here's where most people go wrong, and many people certainly who are in the small business category. They'll go through this exercise and they'll forget to put one critical item in there. What do you think that might be? It's the owner's salary. It's the payment that you'll receive as the owner of the business for doing the business itself. That needs to go in here as either a variable cost. If it's inherent in your delivering the service, you have to do that. It might be here. Most times it's down in fixed cost. It's part of the fixed cost of the business. Whether you sell a product or not, you're going to pay yourself a salary. And I understand that perhaps maybe you're not, but you need to be thinking that way. You need to be thinking that I'm in business and I'm going to pay myself regardless of my sales. That'll motivate you to make more sales, but make sure that your own owner's salary is in your calculation before you go. Now, you need to understand your margins because you want to get to where you can draw this chart out, where you can make this chart that depicts the break-even for your business. Every business has a break-even. It's critical that you know your break-even. So if you've not done this calculation yet, then this is one of your homework assignments. In fact, I've given you a handy-dandy Excel file that you can print off and you can use to actually calculate your break-even analysis. But let me show you first how you calculate it, and then you'll be able to use the tool that I've provided to you later. But essentially, it's a simple chart. On the y-axis of the chart, it's dollars. It's dollar increments, depending on your business size and your unit size of your products. You can make that any numbers you need, but those are dollars. On the horizontal axis, on the x-axis here, it's units. How many units? It might be 1, 2, 3, it might be 10, 20, 30, 100, 200, 300, whatever it is, but it's number of units. And on this chart, what I want you to do is for your business, I want you to calculate these things. First, calculate your fixed cost line. Your fixed cost line will be a horizontal line that represents the cost in your business on a monthly basis, let's say. Let's do this on a monthly basis. Your costs in your business on a monthly basis, regardless of whether you sell a product, a single product, or multiple products in that time period. So what are the fixed costs? These would be the things like rent, insurance, utilities, phone charges, salaries, those things that aren't tied to direct sales. What's that? You got to calculate that line. The second line you need to calculate is your variable cost line. Now this line will go up at an angle, so it'll have a slope to it, and it will start at 0, so that if you sell 0 units, the cost will be 0, but as you sell multiple units, or as you produce and sell multiple units, your costs will increase based on the variable costs, the cost of goods sold for your products and services. So it'll start down at the intersection of 0, and it will slope upwards based on whatever your cost per unit sale is that represents your variable costs. The third thing for you to do then is to take that line and simply move it, adjust it up so that it starts at where your fixed costs are. And what that will then represent are the total costs in your business. These represent the total cost starting at unit 1 all the way up to unit N, however many that is. But those are the costs that you ought to expect to see incurred in your business during this time period, depending on how many units you produce and sell. The fourth line that I want you to put onto the chart is your revenue line. Now the revenue line again starts at the 0 point. It'll start down here at zeros. But every time you sell a unit, you sell your average unit for X dollars. And that unit would then represent, the revenue represented by that line should be a line that's at a slope, and hopefully that slope is steeper than your variable cost line, which means that each time you sell a unit, you have a positive margin. Draw that line. Where the red line, or where the total cost line intersects the revenue line, that represents your break-even point. So that break-even point will come to a certain dollar amount and will come to a certain unit value. That represents the break-even point for that period of time in your business. Anything that's to the north of that, between the total cost line and the revenue line, this represents your profit opportunity. So that the more units you sell, the greater your profit. Now, you need to get this square, and I would tell you, your homework assignment from this is to do this on a monthly base. That's the minimum. Have this for at least a 1 month period of time. But ultimately, what I want you to be able to do is I want you to be able to create this chart on a weekly basis. What's your cost and fixed costs in your business on a weekly basis, your variable costs for each unit sold, and what's your weekly break even. And then I want you to be able to get down to where you can do this on a daily basis. What that will tell you is how many units do you have to sell every day in order to be in positive territory, to be north of your break even. If you can do that on a daily basis and achieve that on a daily basis, you're going to have a great month. But if all you know are your monthly numbers, then you might have a bad week, and it might make it really difficult for you to achieve your break even over the course of a month if a week or two goes by without having achieved break even. You need to know your break even not only on a monthly basis, but on a weekly basis and on a daily basis. And those that are really good at when they understand financial mastery, they'll even know their break even on an hourly basis. Because frankly, every hour matters. You pay people by the hour. And so you want to make sure that you're making profits every hour of your business. But if you've not gone through this exercise, use the template that I've provided to you, the Excel form, and be able to come to this. Okay? Really critical part of financial mastery to understand your break even. Now I want to talk about one thing that's a concept that is really critical for us to get across at this point, because this is fundamental to many businesses. And I've titled this, Stop Discounting. Now, why have I said stop discounting? It goes back to the beliefs about money, and it also ties into the break-even analysis. But here's what I find. I find that many business owners believe that they can buy their way out or buy their way into new business by discounting their prices. And let me tell you let me show you how the fallacy of that thought really does deteriorate what you do. And this causes more business owners more pain and struggle. Let's assume that here on the left, I've got your standard product that sells for $100 and has a 20% margin. In other words, $20 of that $100 is profit. So in order to sell that product, you have $80 worth of cost in the product. So you have $80 cost, $20 profit on a $100 sale item. Now, many people think, look, if I want to sell more of those, I'll discount that. I'll take 10% off my price and I'll advertise a special. So I'll take 10% off. Let's look at what happens when you actually do that. You take 10% off your price, so now rather than selling it for $100, you sell it for $90. But the reality is it still costs you $80. Your margin on that $90 sale is now $10. Here's the question for you. How many more sales do you have to have here when you've discounted your product by just 10%? How many more sales do you have to have at this price to be able to make the same margin dollars that you made over here when it was priced at your standard pricing of $100? How many incremental units? Here's the answer. You've got to sell twice as many. You've got to sell 2 times as many units at a 10% discount in this particular example to be able to make the same margin dollars that can go to your profits as you would when you were here on simply a 10% discount. Staggering. You've got to do twice the effort in order to get the same result. Now, let's flip that around the other side. Let's say for a minute that you said, look, I'm confident in my product, and I'm confident that I provide a good value proposition. I have a good feeling about money, and I'm willing to go ask even more for my product because I believe I'm worth it, and I believe that I can sustain it because I give good customer service. I do things that my competitors don't do. I set myself apart. Instead of selling my product for $100, I decide I'm going to raise my price to $110. So on that same product, my cost is still $80, but now on that $110 sale, I make $30 margin for every unit. Here's the fundamental question. How many customers could I lose by raising my prices by 10% and still make the same margin dollars that I did at my standard pricing? How many customers could I lose and still make the same amount of profit? And the answer is 1/3. I could lose a whole third of my customers, do a third less work, have a third less inventory, have a third less hassle, and I'd still make the same profit as I do over here. Now I got to ask you, why would you discount? You're going to do twice the work for the same profit. Why wouldn't you focus on differentiating your business, adding more value, increasing your prices, do less work, and make the same amount of money? Critical fundamental understanding that you must have that falls into the financial mastery piece. Okay? So I want you to get that kind of clear in your mind. Now, 2 other quick thoughts I want to give you to kind of round out this session. One is, why should I have a budget? Why should you take the time to draw out a budget for the year for your financials? Here's the income that I'm going to make on a monthly basis. Here are the expenses I'm going to have on a monthly basis. Here's my budget, so I understand where I'm going. Let me give you a couple of reasons why. I think this is pretty critical. One is it helps you to think forward. It helps you to think about what's going to happen over the next several months, not just what's going to happen this week or next week. People that have a budget, have a plan, tend to do better because you're looking forward. It helps you to anticipate. Oftentimes, when you think forward, you can anticipate issues quicker than if you just let them happen to you. You'll be in a position to be able to do that. You'll be able to adjust. You'll be able to see, particularly if you set this budget, and then you find that you're trending either ahead or behind the budget, it allows you to be able to adjust, make adjustments along the way, rather than waiting until you're at a point of desperation to have to make some move. And lastly, it helps you to prepare. Oftentimes, when we're doing the budget, we will think about what might likely happen 4-6 months out, and we can prepare for that in advance. It gives us time to react, and that's how we want to run our business. We want to run our business being prepared, being able to adjust, having time to anticipate. Have a budget for your business. I've attached to this file, I've attached an Excel spreadsheet with a sample budget for you. It's a model you can use. You may have to adjust it slightly for your business, but I would suggest you simply, if you have one, that you use it now to be able to get yourself into a simple budget month over month for 12 months going forward. One last thought. Cash flow forecasting. Everything we do in business is about generating cash. Cash is really important. I can tell you that I've seen more businesses go out of business. The one primary reason is they run out of cash. They haven't thought through, they may have a profitable business, but they may have to carry too much inventory and they don't have their cash flow coming in at the time. And so they run into this cash gap, then they have difficulties. A cash flow forecast is critical for every business. You must have a cash flow forecast. A minimum of 3 months. You need to be able to forecast what your cash picture looks like 3 months from now. So that you're not just trying, I hear so many business owners talk about, I'm gonna hope that I can make payroll this week. I'm gonna hope that I can make payroll at the end of the month. You need to know with certainty what your cash position looks like at least 3 months out. Ideally 6 months, but minimally I'd give you 3. Secondly, I'd tell you be conservative. Don't build your cash flow on landing the big client that you've been chasing for the last 90 days, the last 6 months. Be conservative in your estimates and make sure that you know that you can actually run your business and execute your business well within your own cash limitations over the next 3 to 6 months. And lastly, it allows you to be able to establish some reserves. If you do see a place in your future where perhaps you have to buy some inventory and you know you have a time that you've got to carry that inventory before that actually turns into sales and then turns into cash, you can make plans, you can talk to your bank. If you're looking to get a banker will demand that you have a cash flow forecast and that you know exactly when you're going to need the loan and when you're going to be able to repay it back. And he's going to be able to see the trending in your business to be able to do that. But it allows you to be able to establish reserves so that you can meet those cash requirements in your business. Cash is the most important thing, most critical thing for you as a business owner. You've got to have a forecast on what that is. Again, attached to this video, there is a document, there's an Excel file that's a cash flow forecast template. Use it. Put it in place for your business. It's critical that you have it. So let me wrap up here. In summary, I just want to cover a few things just to kind of put a bow on this. Financial mastery is critical. You need to know how to keep score in your business in order for you to be successful. In order to do that, you have to make sure that your beliefs are right. You got to get confident in your use and your thinking around money. And you have to be able to, you have to believe in yourself and believe that you're worth the value that you're charging to your customer. You must know your margins. You must know what goes into your cost of goods sold. What are your gross margins in your business? What are the fixed costs in your business, those overhead items they're going to be there whether you sell a product or service or not. You need to understand your margins. If you've not done your break-even analysis for yourself on a monthly basis as a minimum, you must do that right away. That's a critical one. If you're in business, you have to know your break-even. You have to be able to know, I have to sell this many units in order to cover my costs, both variable and fixed in my business over this time period. Stop discounting. Don't discount. Find ways to add value to your product, add value to your customers, so that you can give them more than what they paid for. Don't discount your product. It's a losing proposition. Have a budget. Don't try to run a business without a budget. It'd be like going on vacation without a plan. You wouldn't do it. Don't try to run your business without a budget. Lay it out. Here's what I expect to bring in. Here's what I expect to go out. Here's how that comes to the bottom line so that you can plan and adjust accordingly based on your budget. And lastly, forecast your cash flows. Make sure you understand how cash moves in your business, because many people get trapped by having a decent business, having a solid business, but having lousy cash flow management. Don't find yourself there. Get firm on your cash flow forecast. I've given you 3 tools to be able to do that. A break-even analysis tool, I've given you a budget template, and I've given you a cash flow forecast template. Use them. Take advantage of this. Put them in place in your business. Give me some feedback on whether this was helpful or not, and I'll look forward to seeing you on the next section in the mastery area, where we're going to focus on how you spend your time. I'm Rich Allen, your business coach. Thanks for staying in there with me today.